In 2014, an economics professor named Richard Werner sat inside a small German bank to observe a real loan approval. The books were open. The computers were running. He watched the entire process unfold right in front of him. What he saw challenged one of the most common beliefs about banking. Instead of watching money move from an existing account, he watched it come into existence. Most of us grow up believing a simple story. You deposit your paycheck. The bank keeps a small portion in reserve, then lends the rest of your money to someone else. It sounds logical. After all, something as powerful as money must come from the government or a central bank. For decades, even many economists accepted that explanation. But think about savings accounts. They often pay almost no interest. If banks truly depended on customer deposits before making new loans, they would compete much harder for your savings. They would need those deposits to keep lending. Yet they don't. That raises an important question. If banks don't need your deposits to issue a mortgage or a car loan, where does that loan money actually come from? To understand the answer, you first have to separate money into its different forms. There are central bank reserves, which ordinary people never use directly. Then there's physical cash, the bills and coins in your wallet. Now look at the total money supply. Surprisingly, the cash printed by the government makes up only a tiny fraction of it, often less than 3%. So where does the other 97% come from? The overwhelming majority of modern money exists only in digital form. It isn't printed at a government mint. It's created inside private commercial bank. Here's how it works. Imagine you're approved for a $10,000 loan. You sign the paperwork, and the bank begins its accounting process. Every bank uses double entry bookkeeping. First, on the asset side of its balance sheet, the bank records your promise to repay $10,000. At the exact same time, on the liability side, it credits your account with $10,000. One signature creates two accounting entries. No money is transferred from a vault. No existing customers' savings are moved. A brand new deposit now exists, but the story doesn't end there. As you repay the principal over time, that money is effectively removed from circulation. The principal is erased from the money supply. The interest works differently. That remains with the bank as profit. In other words, money is created when loans are issued, and it's destroyed as those loans are repaid. The amount of money circulating through the economy expands and contracts based on these lending relationships. The people working at banks aren't necessarily trying to manipulate the system. Most are simply doing their jobs within the incentives the financial system creates. Imagine walking into a bank and asking for $50,000 to start a small local business. You'll probably face extensive paperwork and careful scrutiny, because recovering that money is difficult if the business fails. Now ask for $500,000 to buy a house. The experience is often very different. Why? Because a house provides reliable collateral. If you stop making payments, the bank can recover much of its money by selling the property. That single difference changes where new money flows. Commercial banks naturally direct a large share of newly created digital money into real estate because it's considered a lower risk loan. But the number of available homes doesn't suddenly increase. Instead, more and more newly created money compete for the same limited supply of houses. And when more money chases the same asset, prices tend to rise. Housing shortages and population growth certainly matter, but the continuous expansion of mortgage credit adds another powerful force pushing prices higher, regardless of how many hours the average person works. Richard Werner argues that creating money isn't the real problem. The bigger question is where that newly created money goes. If banks direct more lending toward productive businesses, those businesses can hire workers, invest in equipment, develop new product, and expand production. In that case, new money helps create new value instead of simply increasing the price of existing assets. Werner often points to China's economic reforms in the late 1970s as an example. While economists continue to debate the importance of different policies, he argues that expanding local banking allowed more credit to reach regional entrepreneurs. That helped support decades of economic growth and fundamentally change the country's economy. This accounting ledger reaches far beyond the walls of a bank. It reaches into everyday life. Your paycheck is more than numbers on a screen. It represents early morning, late night, missed weekends, and the time you spent earning every dollar. When banks create new digital money that mainly flows into assets like housing, it can reduce the purchasing power of the income people work so hard to earn. The ledger isn't just a record of numbers. It's a map showing where society directs its resources, who receives newly created money first, and how those decisions shape the economy we all live in.